What's up, guys? Chris here from Blockchain Brothers, and today we're going to have a look at market makers, what they are and how they operate. So market makers are institutions that facilitate the buying and selling of assets, so going long or going short through leverage. They add liquidity to the market basically, and a hell of a lot of liquidity to the market across all different institutions. So there's many different market makers. They'll all operate in a similar fashion. So they make their money through spreads. So if you were, say, for example, long in the pound dollar and you thought this is going to go long, you wouldn't actually be paying the spot price for your entry. You'd be paying a little bit above that. That's where they make their money. Obviously, the more volume is in a pair, the less the spread will be. But sometimes the spread can be quite high on any sort of volatile assets or any assets that don't have enough sort of volume and liquidity going through it. They also make their money through liquidations and hitting people's stop losses. And this is a key thing in trading, and this is why a lot of people lose money in trading, because they don't understand how the market makers actually work. So I'm not saying they will go for your individual stop loss. They'll go, oh, someone's put a stop loss here, we'll hunt that down and get it. But what they're looking for is the most liquidity. So you've got to think of it as if you were a market maker, if you were lending out money to people, because again, that's what they're doing. It's some of these things are highly leveraged, like 100x and like minimum sort of 10x. So they're lending out a lot of money, and your capital's at risk because you're putting up a small deposit or small bit of collateral to be able to leverage. And obviously, if it goes the wrong way and you don't have your stop losses in place, you'll get a margin call. You have to add more money, otherwise they will close your position and take your money. When you're lending money out as a market maker, they'll get a point where you're thinking, right, well, I've added enough liquidity out there, I've lent enough money out to people, we need to get some of that liquidity back. So that's what they'll do. They'll go for and they do it all the time in the markets. So for example here, if we sort of draw a support / resistance, for a lot of people, they might have seen this break, come back up and thought, right, I'm going to short this now. So say they did short the market, and what's the typical sort of risk to reward ratio? It's 3R, so 1 to 3. So we go down to the 4 hourly, you would have got in here, you do your 1 to 3, and this is where they get people all of the time. There, roughly 1 to 3. A lot of people would have put a short position there because it's come up to a resistance. Because they would have shorted that, they wouldn't have come down to their mark, because this is your 1 to 3, that's your take profit there. And they swung the market back round to take all of the stop losses, because everyone would have seen this, so the majority of people would have done this. And this is what you have to get used to in trading, and this is why you have to think like the market makers, because you need to be thinking where they will be getting their liquidity, where they will want to be coming back to grab all those stop losses, because they make profit on those stop losses and they also get their liquidity back. And this is what would happen, knocked out and then come back down. So this is a very good rule of thumb. Again, you've got to stop thinking like the masses, because the mass doesn't win. You have to start thinking like a market maker. And if you were thinking to yourself like I would have, well, I can see that touching, so I would put a short position there, but I will, just to be safe, put my entry where, and this is what smart traders do, they put their entry where other people's stop losses would be. So I'd put my entry there. Well, now, if I'd have done that, and this is all to do with risk management of trading. Market makers know what everyone is thinking. They know what people are seeing. So they will know where people's stop losses are. because 1 to 3s are very common across any sort of trading. 1 to 3 is the most common sort of risk to reward ratio. So they know where people's stop losses are going to be. So if you would have put your entry, your short position, where everyone else's stop losses were on this one, say you took your take profit there, you'd be up 4%. It's things like this you have to do because they do it all of the time. And again, most people, once this broke and come back down here, would have put a long position in because they would have thought, well, it's broken that sort of resistance. It's come back down to kiss it as a support now. So they would have won both ways. They would have got people's stop losses both ways. And this is why people keep losing at trading, because they're seeing things that everyone else is seeing. We've all been taught the same way. To look for patterns. Market makers do it with each other as well. They're not just after retail, they're after everyone. They don't actually care which way the market goes. All they care about is constantly getting that liquidity, constantly liquidating stop losses. So this is basically how market makers work and operate. My advice to you, if you want to improve your trading, whenever you see a setup, just put your entry where you would normally put your stop loss. It won't always hit it. Again, market makers only really go for where the most liquidity is, and that's why they'll whipsaw sometimes just to keep grabbing all of that liquidity. But the majority of the time, they'll always turn back round and grab that liquidity where it is at most. To really improve your trading, think like the market makers. Anyway, guys, I hope this helped. Don't forget to subscribe, like, leave a comment, share, ring that notification bell, and I'll see you on the next one.